What's up? What's up? We are back again with the next video in the trading A to Z. And today we're just going to go over risk to reward. Um, you know, I just wanted to give an example on this because everyone has their own ideas. Some say you need a 3 to 1, the golden ratio is 5 to 1, 10 to 1. However, it is. I don't really preach too much about this one. What I don't like trading for me personally are the roulette trades, which are the 1 to 1. I'm taking a trade. My risk is going to be $1. My gain is going to be $1. Should it all plan out? I call those roulette trades, and I still take them sometimes. I'm not against them. If the trade's there, the trend's there, everything's there. I don't have a problem with it. I don't see why not. What I find a lot of people doing is spending a whole lot of time looking for that golden ratio when there are plenty of trades to be made in the meantime. Instead you could just adjust your position accordingly. And I wanted to pull this up. This is just Spider SPY 500. And so, just to give an example, we have these two zones right here, right? This is your buy, here's your sell. Let's say you're watching it right here. We're starting to break above it. We're hesitating right here, but we finally get above it. We're confirming it, but we're getting above it. We're making this higher time frames. You could have taken your trade down here, but we're going to keep it very simple. You got in here. Here's your entry. Here's your exit. Right here in this middle mark, that's going to be that roulette trade. So if you took your position right here, you stand to lose $1 for every dollar you gain. And then that's how you find this ratio. Obviously, if you got in way down here or over down here, your trade went perfectly well. It went fine. You had almost, if you got in right here and you were going to cut your losses just below it, and you exited right here, you'd see that it went perfectly, and you could trade. That ratio would be 1,000 to 1, depending on what your shares were and how tight that stop was right there. And that's kind of why I want to give this example, because I do find a lot of people spend more time looking for that ratio than they do looking for the trade. Again, let's say if you got in right here, I wouldn't have liked this trade right here. It's a 50-50 trade. As you can see, if we got in down here and sold up here, you were just fine. But if you got in here, your risk, you have to understand, if it comes all the way down here into this zone again, that's perfectly normal. So tagging out, getting in right here and stopping out right here was a meaningless stop loss. If you've identified this zone as a buy, this zone as a sell, you got in here, and your stop loss shouldn't be anywhere in between here. And I do have a video going over the stop loss and how to do it correctly. But you just shouldn't be doing that. You would have just taken a meaningless loss for a trade that would have worked out perfectly anyway. So that's why they're talking about the golden ratio. If you got in down here, if you got in over here, or if you got in here with a smaller position with a little bit of leeway to get up here, or to get down there and turn around and come back, everything worked out in your favor. Again, obviously, these it doesn't have to ever turn around like this. This is a great example. It could have just kept going, and that's where you would cut losses. So if you whole accounted it right here, if you're new and you're emotional, you probably got really excited right here, and right here you're really down. So again, the ratio is talking about win per loss. If you were to get in, let's divide it right here in the middle. Right here, not going off any candles. It just happens to be right there. That's that middle mark. Here's your 1 to 1 ratio. I personally like anything below that. If I'm going to go long, I want anything below that. I try to get down here. I buy in these zones, obviously. But that's where I try. Anything above here, I don't like taking, maybe for a quick scalp, and I would try to find a shorter time frame zone in the meantime to cut my losses. But again, I just wanted to go over that because I personally don't have a rule to preach about this. I don't care. As long as there's so many other factors that can give you clues as to, is it going in your way? How could this have played out? Like right here, if you've identified this as an old resistance turned new support, and you wanted to get in right here, you still have these two zones. Yeah, that's a roulette trade because you're 1 to 1. But you could have easily gotten in here and maybe had a stop loss right here. Assuming if it broke that resistance, maybe even gave it to these wicks, it's probably going to head down and give you a better entry down here anyway. And you can wait for a further bounce up there. But again, that still would have been just fine. I could have taken a position here. I would have just had a smaller position, assuming my stop loss would be here, or even smaller position with the stop loss down here, and I still would have made money. So that's why it's almost personal preference. It's good to find 3 to 1, 5 to 1. Those are awesome, and it's always good to have those. But to get those every time, if it's taking away from you actually trading because you can't find it, I'm not saying rush into a trade. Don't force anything. But just be mindful of that. There's other ways to take the trade without betting the farm on it and losing all your money. So that's it for today's video, guys. Again, Trading A to Z, this whole playlist is everything I know about trading to teach you everything I possibly can. So if you like the video, please subscribe. Thumbs up, I do appreciate it. And I'll see you guys on the next one.